Assalamualaikum warahmatullahi wabarakatuh. So today, my team and I will present our project-based learning report with title Study Analysis of Apple Incorporate and Samsung Electronics Taxation Activities for the International Taxations, and we are from Group 5. And we are consisting of me, Yuni Wulandari, and two of my friends, which is Kinanti, Ranum, Falina, and Dinda, Putri, Medina. All right, first we are going to explain about the company profile, which is the first one is Apple Incorporate. So Apple is a global technology company headquartered in Cupertino, California, and then founded in 1976 by Steve Jobs and his team. Apple has evolved into one of the world's most valuable tech companies, and for the vision, Apple has vision to make the best products on earth and to leave the world better than we found it. And then for the mission, they have to create technology that empowers people and enriches their lives. And then for the Apple's products, as you can see on the screen, there are a lot of their products, which is consisting of hardware, software, and services. And now let's move on to Samsung Electronics company profile. So Samsung Electronics is based in South Korea, founded in 1938 and expanding into electronics in 1916, which is the founder itself is Lee Byung-chul. And then for the vision, Samsung has vision to inspire the world with their innovative technologies, products, and design that enrich people's lives and contribute to social prosperity by creating a new future. And then for the mission, they have mission to devote their talent and technology to creating superior products and services that contribute to a better global society. And then for the Samsung's product, there are a lot of their product, which is you can see on the screen. There are consists of mobile devices, consumer electronics, and semiconductors. And then for the problem statement and objective for this presentation, there consists of three problem statements. The first one is how do the tax jurisdictions of Apple and Samsung influence their international tax strategies and overall tax obligations? The second one is in what ways do Apple and Samsung utilize foreign tax credits? And then the last one is what role do tax treaties play in Apple and Samsung? And then for the objectives also consists of three parts. The first one is to analyze how the tax jurisdiction of Apple and Samsung shape their international tax strategies and affect their overall tax liabilities. Second one is to identify the use of foreign tax credits by Apple and Samsung in reducing or avoiding double taxation. And then the third one is to evaluate the significance and implications of tax treaties in the international tax planning of Apple and Samsung. And then the next one is about the literature review that will be delivered by my friend.
Okay, so first I will explain about the types of tax and rates. So there are basically four basic words that we have to know regarding the taxations. The first one is the type of taxes, which is consists of income tax and withholding taxes, also the value-added taxes. For the income tax, it is tax that usually levy direct corporate income taxes on business profits, with its rates varying mostly between 20% and 35% suggested on each country's regulations. For example, Switzerland imposes only an 8.5% national tax, but in Zurich, the effective rate of taxes could be over 21%. And for the second one is withholding taxes, which is taxes that levied by governments on income such as dividends, interest, and royalties paid to foreign entities. And the tax havens means that there are several countries that offer extremely low or even zero corporate income tax rates. For example, there are Bahamas and the Isle of Man, which charge no corporate tax, and also Liechtenstein that has tax rates as low as 7.5% to 15%. And the last one is value-added tax, which is functioned as alternative to sales tax, usually included in the price of goods and services. For example, in Indonesia itself, the VAT is 10%, and the European Union, the VAT range from 15% to 25%. Okay, so the next one is the tax jurisdictions. So basically, there are two sessions of approach for the tax jurisdictions, which is the worldwide approach and territorial approach, and then also the source of income, citizenship, and residence. So for worldwide approach, a country taxes all the income of its residents or incorporated companies, no matter where the income is generated. But for the territorial approach, only Levite taxes income that earned with the country's borders. And for the other approaches, including source of income, which is a country taxes all the income of its residents or incorporated companies, no matter where the income is generated. And then the next one is citizenship. Some nations, most notably the United States, apply taxation based on citizenships. This means a U.S. citizen is subject to U.S. tax on global income, even if they live and work abroad. And the last one is residence, which means that the taxation there is based on where the individual resides, not necessarily where they are a citizen or where the income originates. Next slide, please. Okay, so there is also a word named double taxations, which means when the countries apply a worldwide tax system and use different tax bases, that leads to overlapping claims by multiple jurisdictions and result in double or even triple taxations. For example, U.S. citizen living in Germany who earns income from Austria might face tax obligations in all of the related three countries. So for the solution of this double taxation, many tax systems aim for tax neutrality, meaning tax laws should not interfere with business or investment decisions. And there are methods to eliminate double taxations, including exempting foreign income, allowing a deduction for foreign taxes paid, and also to provide a tax credit for foreign income taxes paid. Next slide.
And then the next literature review, it's about the treatise, which is consists of three parts. The first one is model treatise, which is consisting of two model. The first one is OECD model, which is limits state rights to where there's a permanent establishment. While the second model, which is United Nations, gives more taxing right to developing countries. And then for the next is about US tax treaties, which is this model has its own model treaty used in negotiating bilateral tax deals. And also the last one is treaty shopping, which is refers to when someone from, for example, country A set up a company in country B to take advantage of country B's tax treaty with country C. And then the next literature review, it's about control foreign corporations, which is consists of three parts. The first one is subpart of income, which is income that is easily movable to allow tax jurisdiction. This subpart of income consists of four types. The first one is income derived from insurance of U.S. risk. Second one is income from countries engaged in international boycotts. Third one is certain illegal payments. And then the last one is foreign-based company income. And then for determination of the amount of CFC is currently taxable in the U.S. depends on how much of it comes from subpart F activities, assuming no dividends are paid. And then the last is about the safe harbor rule, which is if a foreign country's tax rate exceeds 90% of the U.S. corporate tax rate, the CFC's income is not treated as subpart of income. And then the next is about the translation of foreign operation income, which is consisting of translation of foreign branch income, which is to calculate U.S. taxable income. A foreign branch's next income is converted to U.S. dollars using the average exchange rate for the year. And then the second one is translation of foreign subsidiary income. So in this part, when that happens, the dividend is converted to US dollars using the spot rate on the distribution date. And then the last one is foreign currency transactions. Gain or losses in this part from forward contracts and options used to hedge foreign currency items are combined with the item being hedged. And the last literature review, it's about tax incentive, which is consisting of two parts. The first one is tax holiday, which is that holidays can be highly advantageous for for MNCs, provided the profits remain reinvested in the host country. But MNC subject to worldwide taxation, the advantages is lost once the foreign profits are brought back home as dividends. And then the second one is about the US export incentive, which is consisting of four parts. The first one is Domestic International Sales Corporation, which made in 1971 to encourage export. And then the second is Foreign Sales Corporations, which is made in 1984 to support export activities. And then the third one is the FSC Repeal and Extraterritorial Income Exclusion Act of 2000. This system replaced the FSC rules with an income exclusion that aligned more closely with Europe tax practices. And then the last one is American Jobs Creation Act of 2004. This model is used to replace the ending ATI benefit. So the AGCA introduced a gradual tax deduction for domestic manufacturing. And then the next, it's about the study case that will be delivered by my friend.
Okay, so for the Apple study case, in November 2023, a long-term dispute over Apple's Irish tax treatment burst back into the headlines when Europe's highest court overturned a lower court decision, fully reinstating a 2016 European Commission state aid ruling. Under that ruling, Ireland had in effect granted Apple preferential tax rates, allowing it to shift substantial non-US profits through a so-called double Irish arrangement far below Ireland's statutory rate. Although the General Court of the EU had in 2020 sided with Apple, the Court of Justice of the European Union, or CJEU, on September 10, 2024, found that the lower court had misapplied EU law. The CJEU's final judgment compels Apple to repay the Irish Treasury €13 billion plus the interest for the years 2003 until 2014. This decision, championed by the EU's competition commissioner, Margrethe Vestager, marks the culmination of a decade-long effort to clamp down on selective tax advantages within the single market. It underscores that European Commission's mandate to recover aid that distorts competition and may shift the tax planning strategies of other multinationals operating across EU borders. The Apple case thus provides a striking example of the EU's rigorous aid enforcement and its potential to reshape global corporate tax planning. And for the Samsung study case, it will be explained by Kinanti.
Okay, so now I will explain about the case of Samsung Electronics. So later on in 2013, the Directorate General of Taxes, or DJP Indonesia, conducted a tax audit on PT Samsung Electronics Indonesia and found discrepancies in the company's financial reports. The audit concluded that PT Samsung Electronics Indonesia had made errors in calculating its tax liabilities, resulting in significant underpayment of taxes. So the company argued that the DGP's calculations didn't align with business realities or their interpretation of tax regulations. On the other hand, the DGP stood by the result of its audit, asserting that the company was obligated to pay the additional taxes assessed. And dissatisfied with the rejection of its objection by the DJP, PT Samsung Electronics Indonesia then filed an appeal with the tax court in 2015. And then in 2017, accepting most of PT Samsung Electronics Indonesia's objections, it is ruled that the DJP's tax assessment was not entirely accurate and ordered a revision of the previously determined tax liabilities. So in 2017, Samsung Electronics could be seen won this case. However, in 2020, the DJP was dissatisfied with the tax court's ruling and subsequently filed a judicial review with the Supreme Court regarding this file. And then the tax court decision in number PUT for year 2020 then become the final determinant of this case. Next slide, please. Okay, so I will explain the first subchapter connected with this study case, which is the two companies, Apple and Samsung. So for the type of taxes and rates in Apple Incorporation itself, according to their financial statement up to 2024, Apple has paid over $35 billion regarding their corporate income taxes. And according to their annual report, the income tax rate used by the Apple Incorporation is 21%. And for the Samsung Electronics, since it is headquartered in South Korea, then they use the Pillar 2 tax legislation based on Korean IFRS 1012 related to corporate income taxes, according to their 2024 notes to the consolidated financial statements. And then the tax rates used also vary based on the tax jurisdiction. And regarding the tax jurisdiction of both companies, I actually have explained before, these two companies are placed in several countries according to its subsidiaries. For the Apple Incorporation, since it's headquartered in US, so they usually use tax applied in the US, and also for the foreign jurisdictions, including Ireland and Singapore. And for Samsung Electronics, since it's headquartered in South Korea, then they follow tax jurisdiction there. And also they have also company subsidiaries placed in various countries, including China, United States, Germany, Japan, Singapore, and other countries such as Middle East, Africa, and others. So they usually follow the tax jurisdiction there. And then the next one is the foreign tax credits from both Apple Incorporation. So according to Apple Incorporation 2024 financial statement, as of September 28, 2024, the company had a $5.1 billion in foreign tax credit carry forwards in Ireland. So this is like related in this study case that Dinda has explained before. And also there are $3.6 billion in California research and development carry forwards, both of which can be carried forward indefinitely. And for the Samsung Electronics, eventually there are no foreign tax credits happening. And for the tax treaties itself, for the Apple Incorporation, the tax issues involving Apple Incorporations were not primarily about tax treaties like bilateral tax agreements between countries, especially the case with the Ireland itself, but rather about the tax rulings and also the transfer pricing practices, especially in Ireland, since our study case is placed in the Ireland. So therefore, Apple Incorporation still has not done any tax treaties. And for the Samsung Electronics, they stated in their annual report that tax treaties ensure that profits earned abroad, for example, in the US or Europe, aren't taxed again in Korea if taxes are already paid abroad. So Samsung subsidiary in the US could pay local tax, and when it sends profit back to Korea, or called dividends, the US-Korea tax treaty may reduce or eliminate withholding tax. Then in Korea, Samsung can receive a foreign tax credit to offset taxes already paid in the US.
Okay, so next is for control foreign corporation. In the Apple Inc. does not explicitly declare compliance with CFC rules in its financial reports. However, its disclosure and global tax practices demonstrate it brings the U.S. international tax law, including payment of the repatriation tax and minimum tax on foreign income. Apple consistently emphasizes legal tax compliance and avoidance of aggressive tax planning. And additionally, in their financial statement, Apple stated that they doesn't accept any form of behavior that facilitates the evasion of tax, whether in the UK or in any other jurisdiction. Apple is committed to prevent tax. Apple appears to implement the substance of CFC regulation, especially anti-deferral and anti-avoidance principle, as part of its US and global tax strategy. Well, in Samsung Electronics, same as Apple, Samsung does not explicitly state that it applies CFC rules, but its policies and behavior indicate compliance with the essence of CFC regulation. Samsung demonstrated full of adherence to local tax law in every jurisdiction and explicitly rejects income shifting to tax havens. It stated in their tax management policy and regulatory compliance and fulfillment of tax filing and payment obligation. And also they maintain a transparent relationship with the tax authorities of each country and provide the relevant evidence and supporting documents upon request. Moreover, its financial reports include deferred tax liabilities on foreign subsidiary profits, suggesting it accounts for future taxes on retained earnings in foreign jurisdiction, consistent with how CFC rules function. Thus, although not directly named, Samsung appears to observe the core principles of CFC, which aim to prevent diverse taxation of foreign passive income, consistent with the legal framework of South Korea and other countries where Samsung operates. Next is for the translation of foreign income, both Apple and Samsung apply similar accounting treatments for the translation of foreign operation in FAS. Translation differences arise profit or loss, but rather in other comprehensive income or OCI. Okay, so here the example how the Apple disclose their translation of foreign operation income in their consolidated statement of comprehensive income. And as we can see in previous example, if Apple reported a $395 million gain in OCI from currency transition in their financial statement in 2024, while Samsung disclosed its transitional adjustment similarly within OCI under note 2.4 of its financial statement and also in their consolidated statement of comprehensive income. Thus, both MNCs demonstrated consistent and compliant practices in foreign income translation, reflecting stable currency risk management. And the last is for the tax incentives. Apple and Samsung both utilize various tax incentives with different approaches and scopes depending on their home jurisdiction and global investment strategies. For Apple, they actively benefit from research and development tax credits, both at the US federal level and at the state level, such as in California, with total credits reaching billions of dollars available for future offset. Additionally, Apple previously benefited from export-based tax deduction under the Foreign Derived Intangible Income or FDIR regime, although these deductions have not been reported since 2023 due to phase out. However, Apple has not officially received any tax holidays despite requesting a 15-year tax holiday in India, which was ultimately rejected. In contrast, Samsung gains more from direct tax incentives in the form of tax holidays and investment-based relief offered by governments in countries where it operates, such as Vietnam, India, and also the United States. In Vietnam, Samsung received a 100% corporate income tax exemption for 4 years, followed by a 50% reduction for the next 9 years. And in India, Samsung was granted a 7 billion rupee incentives package, including tax exemption on land transfers for its display panel factory. And last, in US, Samsung secured up to $6.4 billion US dollar in direct CHIPS Act funding, as well as 25% investment tax credit or ITC on capital expenditures. While Samsung doesn't itemize these incentives in detail in its consolidated financial statement, it reports them collectively under tax credits and exemption totaling 6,566 trillion Korean won in 2024. Okay, so for the conclusion, this project shows that Apple and Samsung, although both are large global companies, they have different ways of handling international taxes. Apple, that basically based in the US, used tax strategies like the double RRs to reduce its tax bills in the past, but now follows US rules like the LTI to pay tax on foreign income, while the Samsung, that basically from South Korea, follows foreign tax rules and avoids aggressive tax moves. Both companies don't directly mention CFT rules in their report, but they act in line with them, like paying tax on foreign income and avoiding tax havens. Apple uses tax credits from research activities and foreign tax payments. Meanwhile, Samsung gets tax holidays and government support, especially in Vietnam, India, and US under the CHIPS Act. This comparison helps us see how companies follow different tax rules depending on where they are best, but still try to be tax efficient and legally compliant. So from this project, we gain several key learnings, such as we could learn that how international companies deal with different tax rules in different countries. So, and we can more understand the difference between smart tax planning and aggressive risky tax behavior. We also could know how global efforts like OECD rules are trying to make tax system fairer, and we also can see the real world application in international taxation. Okay, so I think that's all from us. Thank you so much for your attention. Uh, we hope that especially in international taxation. Wassalamualaikum warahmatullahi wabarakatuh.